Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Back in home studios here today, as right toward the end of February of 2025. Almost 2 months of the calendar year gone. We've completed the Super Bowl. Glad the Chiefs lost. That was great. I'm sure all Cincinnatians feel the same way that I do about that. And looking forward to baseball season coming up here. I know it's basketball season right now. We got UK people going nuts as usual. Pretty good program. As I know that we both went to school there, so we catch that. But yeah, mostly just looking forward to my Red Legs. Hopefully, they're going to have a hell of a year. And with a new manager, going to a couple games already. Got that on the calendar. So we'll see what happens, man. How's your day going so far post Valentine's Day, post Super Bowl, post nearly 2 months of the calendar year?
Well, it's getting off to a great start since I'm in here with you. That's all
Obviously,
I have to
everybody
look
here
forward
is,
to.
is having a good day right now.
Yeah,
Obviously,
yeah. Now having a good day. Like you, I'm shocked that we're at the end of February, or pretty much. I mean, 8 days left.
yep.
That's blowing my mind. But yeah, Super Bowl's over. Obviously, we talk about this on the show every now and then. I'm a big basketball fan, so this is kind of like one of my favorite times of the year when both NCAA men and women are playing, as well as the NBA. For
Yep.
those that don't know, went to LSU for grad school, so big Tiger women's hoop fan. Angel Reese, saw them even back before that when I was there. Simone Augustus was lighting it up. We were a Final Four team. But anyway, so yeah, also looking forward to baseball season. I'm also a huge Reds fan. Maybe not quite as zealous as Joshua is, but they're definitely my favorite team. And not to be a contrarian, but also a giant Shohei Otani fan. So I'm hoping this year
I
we
get
see
that.
him pitch as well. I can't wait.
I'm going. I'll be at the Dodgers game when they come into town.
Yeah. Oh my God.
Uh,
If he pitches and hits, that's going to be the coolest thing.
Yeah, yeah. We actually saw him last year when the Dodgers came into town, and the Reds smoked him. I think Otani was 0 for 4 that night, so he didn't do anything. Obviously, he didn't pitch.
Yeah.
But I'm going, definitely going back. I wish I could catch the Yankees series too. The Yankees are coming into town as well, but
Mm.
I'm gonna miss that one. But
Yeah.
anyway, exciting time to be alive.
Exciting time to be alive. And again, Reds fan, the Dodgers, they kind of have everything because they just go by it. But he's such a cool player. I love watching him. So,
Yeah, and other news. This is breaking news. I have the news on in my home office here. But Mitch McConnell, Kentucky senator for my whole damn life, not even joking, um, is announcing he will not seek reelection in 2026. That's not that much of a shocker, but
no.
Uh, they've been trying to fire his ass out of Kentucky for my whole life,
Yeah, my whole life.
and never worked. So I guess congratulations, Mitch, on an upcoming retirement. I'm glad that somebody else is going to get a crack at it now. So we'll see. Anyway, that's not what we're here to talk about today.
No.
Today is, as usual, a whole lot of ground to cover. We got earnings, we got inflation data. I got some comments on some Fed information, a lot of volatility over the last day and a half of trading. I have some thoughts on that, plus some historical data. So if you're new to the Shepherd Wealth Management podcast, thank you for watching. Please like, share, subscribe. That way you are aware every time we drop one of these podcasts. About every 2 weeks. The nature of the program here is to kind of give you the historical data that the news does not. And the reason why we find value in that, not just for viewers of the show, but for my personal clients. So just so you know, Shepherd Wealth Management is a registered and independent registered investment advisory practice headquartered in Cincinnati, Ohio. We manage about $120 million of assets for customers across the United States. We have clients in about 15 different states as of right now. And we've been in business since June of 2021. So about a little over 3.5 years at this point, coming up on 4 years. We're doing a big client celebration event coming up next week. So very, very excited about that. There'll be a whole lot of new announcements coming from me directly regarding website and a whole bunch of other things. So stay tuned. Um, but the other thing that's super exciting here that I want to make sure that we make sure the viewers are aware of as to why we do this program is Warren Buffett talks about a couple of things that are crucial if you're going to have sustainable success as an investor over time. With all the news headlines that are hitting our smartphones throughout the day constantly, we get more information now than ever in any other point in time in history. Of course, a lot of that's great. Love technology. Huge fans of that here. I know Ez and I are, but a whole lot of information is hitting the human brain and conscience all at one time. And Buffett talks about the number one reason individual investors do not achieve the results they're looking for consistently is they have no control over their temperament. In other words, they can't control their emotions. And I'm not too surprised with these smartphones and technology and the way that information flows these days. I mean, it's right in front of our face constantly of all the things we need to be afraid of or worry about as it relates to things like investing. Well, that's fine and dandy. I think the news should bring things to our attention. But what they do a terrible job of, in my view, is they never bring up any historical context, or at least they do it very, very rarely. And when they do it, it's like a quick little 20-second clip, and then they're moving on to all the reasons why you should be worried. Well, there's a very scientific reason for that. These are for profit news outlets, and there's nothing wrong with that. I'm for profit too. Go make your money. But what they understand is human behavior. You can actually get a PhD in this thing called behavioral finance. It's just a study of how individual humans make decisions with their money under quote unquote stressful circumstances. And what we found from that study is that humans feel losses twice as much as they feel good about making a gain. Therefore, we are risk averse by nature. That is the reason why the news mostly has headlines that are more fearful because it keeps you twice as engaged, which means you're going to stick around longer. They can sell more ads at a higher price. That's how they make their money, etc. What we try to do here is say, yeah, this is what's going on. The news did bring this to all of our attention, but here's what history has to say about this. The reason why that's important is because it puts things into their proper context. Human beings, by the way, are pretty much the most predictable thing on the planet. I mean, we've been around for a couple thousand years and we really haven't changed all that much. We've gotten a lot more advanced technology and so forth, but the human beings, their behaviors are very, very predictable, specifically over time. And the stock market is a great place to build wealth over time. It's a terrible place to get rich quick. And if you just look at the market over a 1 day period, it's like a live autopsy of human emotion. And we've seen a lot of emotion here over the last day and a half. I'm going to talk about that here today. But where we're getting an edge for clients, the reason why or one of the reasons why we're celebrating next week over the last 3.5 years, for every client that's been with us at least 3 years or longer, we've on average tripled the performance of the S&P 500. And you might say, well, the markets were awesome the last several years. Yes, they have been. We're much better. But I started the company in a bear market. I did not have my president, John Ashcroft, working with me at that time. And the market was brutal our first full calendar year in business. We did do better than the market, which we can talk about, and I'm sure that we will. But the reason why we're getting that edge of performance over the S&P has very little to do with, me being so intelligent. I'm reasonably intelligent, right? I passed the exams. I went to college. I was a good student. I'm no Elon Musk type. I'm no super genius, that can send things out to outer space and catch them with chopsticks. There's all kinds of really other cool examples I could give you. I am not that brilliant. But what I do understand is I understand the basics of investing, the table stakes stuff, if you will, the balance sheet, income statement, cash flows, et cetera, et cetera. Again, I check the boxes for the things that everybody in this business is good at. But where we get an edge for customers and the edge on the market is we take all that historical context and that gives us probabilities. We clearly understand the risk and reward for every decision that we make on behalf of our customers. And by putting the proper historical context into every decision, not only do you get a clear understanding of the risk and reward, but you have full control over your emotions. You're thinking very clearly now because you know how other human beings have behaved under very similar circumstances that we're dealing with today based on prior instances. Now, for all the compliance people out there, past performance is no guarantee of future results, and investing involves risk, including risk of loss. Of course, that's true. And there are certainly times where our process, even though we look at the market through this historical lens, and it's given this edge of performance relative to the S&P 500 since we've been in business. There have definitely been points in time where we're looking at the market through a historical lens backfired. Matter of fact, I can think of September last year. I forget the exact data point, but we were looking at the market going into September. September is historically not a awesome time to be an investor. If you just look at the month of September over a long period of time, and there was a piece of data there that said, hey, there's basically a 0% probability of success here in September. And actually, that September was up almost 2.5%. So that one historical data point, although it was true for the last 100 years, last September it bucked that trend. So there's no such thing as a perfect investment strategy. I don't care who you talk to. Warren Buffett himself would tell you that there's no perfect investment strategy for every single moment in time. But when you look at the market through this lens of history and you understand how other human beings have behaved, you do get full control of your emotions. And once you have full control over that, and you understand what the risk and reward is, now you can start to allocate your resources in the places where you want to take that risk to achieve that type of reward. And that's exactly what we do here for our customers. We remove that emotion from the investment equation, look at the market through a lens of history, and make decisions accordingly. And that's exactly what we're going to be talking about here yet again today. So please like, share, subscribe to Shepherd Wealth Management Podcast. This would be a great gift, by the way, for all your friends and family members that are very emotional when it comes to things like talking about the stock market. So, if you want to give them the gift of getting control over that, give them the Shepherd Wealth Management Podcast, or just have them call me 513-630-2664. Now, enough of that. Let's get into the meat and potatoes of today's program. I want to start with earnings today, Ez.
Let's do it.
And the reason why we want to start with earnings, other than the fact that earnings are the most important data point, I'd say, if we're just looking at the stock market, I'd say that and jobs, most important thing. But we're basically through earnings season. We've got a few companies left, I think this week, and maybe a couple trickling in next week. But 411 companies have reported of the 500 that make up the S&P 500. That's 82% of companies, and 78% of the companies that have reported their earnings so far are beating their earnings estimates. That's awesome. And they're beating their earnings estimates by a median of 7.2%, which is also fantastic. The S&P 500 thus far for companies that have reported earnings is showing a earnings growth rate year over year of 17%. This is fantastic. Okay. A lot of
Wow.
people were hoping to see these kind of earnings results coming into 2025, and earnings season has delivered. I'm going to get to the volatility that's happened here recently. But real quick, as I know that this isn't what you do for a living. So I asked this question because I think it's a good question for the people watching the program here. I know that you keep up with news, right? You don't
I
manage
do.
$120 million for a living like we do
No.
here, but you do keep up with the news. Have you seen in the news in any way, shape, or form that kind of data? Earnings are fantastic, 17% growth year over year. And I mean, I know what the answer is, I think. That's kind of the reason why I asked the question.
Yeah.
But I mean, have you heard anything like that yet?
I have not. I've not heard any ounce of positivity in the news. And you know what? It's been that way for the last 2 years when we've literally gone through the strongest economy in the history of the world. No one has ever decided to really rely on that. It's always been recessions coming, fear and gloom, all this stuff. So yeah,
Yeah.
no one's ever said, "Hey man, earnings season's going great. Corporate health is really awesome. That side of our economy is banging." I haven't heard any of that.
No, and you probably won't because, there's all other political news going on, obviously. And this is not a political
Disasters.
program.
It's been a rough start to the year. Our state's been hit hard, Kentucky,
Sure. Yeah, flood
California.
recently. Yeah, California wildfire. I mean, we can go on and on,
Right.
right?
Yeah.
That's what's been on the news. So again,
Right.
like, share, subscribe to this program if you want to get some true financial news here, because that's fantastic earnings. That's what people were hoping to see coming into this year, but relative to everybody on, whether it's Fox Business or CNBC or pick your favorite financial news outlet. Um, Everybody kind of thought that this could be a good year as long as earnings came through because markets were priced for quote unquote perfection, according to some pundits. Any shortfall in earnings, the market would fall back quite a bit. I mean, that was kind of the headline coming into this year, and we just haven't seen that yet from corporate America. So if this is news to you, you are welcome. and we got more to get into here. So I want to shift gears a little bit now. We've covered earnings; they've been awesome. We're basically done with them. A few companies left to go. Shift gears to inflation conversation a little bit because this is yet again something that's just unfortunate. It's being kind of glossed over here from most news outlets. Again, I know that there's other things going on in the world here, and I am charged with running a investment firm, so I care about this stuff. And maybe the news has other things to talk about that are more engaging for their audience. But I do want to talk inflation here because this was also something that I think was very much glossed over. So some of the inflation numbers did come a little higher than expectations. For example, January CPI, the headline inflation number, came in core CPI 0.45% month over month. That was a notable acceleration from recent months. However, when that news did come out, there was an initial market sell off, but equities recovered. So, why is that? It has a lot to do with the underlying data points. And this is where the news dropped the ball, in my view. So, housing, which is the biggest component of CPI, by the way, it's about 40% of the whole bag. Auto insurance and used cars, that made up 0.37% of the 0.45% increase in headline CPI inflation. We've said this as I don't know how many flipping times over the last 2 years. Housing has the longest lag effect. Matter of fact, the housing data is showing that the shelter, again, that 40% that makes up CPI, that's falling month over month at every reading that we've seen for the last several months. Okay. It's not talked about in the news at all, but it's the biggest weighting. As long as that continues to fall, you will continue to see that fall. We also had Mayheim used car price index come out today. It's showing a negative number month over month. Um, Again, we've talked about all this stuff for the last couple years. You can go back to YouTube and view that if you'd like to binge watch it if that's something that you're into. But yes, monetary policy adjusting interest rates does affect things like housing. It just takes a long time for that to happen. Now we're finally starting to see that show up. Auto insurance and used cars, the Fed can't do a damn thing about that. Okay, these are data points that have to be measured along with a whole bunch of other stuff. But the reason why auto insurance, as an example, went up is because remember this thing called COVID when they shut down the whole global economy and you couldn't get a car because there were no chips. Well, that caused prices to go up, right? There was demand, very little supply, basic economics, prices go up. Well, if your car price goes up and you get in an auto accident, obviously your premiums would go up. But just because the car is now the market value is more when you go purchase it, well, it would cost more to replace those parts, right? So they have to increase the premiums, et cetera, et cetera. This is not anything that monetary policy would impact in any way, shape, or form. So the market saw that headline CPI inflation from January. Initial knee-jerk reaction, equities recovered because they understand, the information I'm providing the audience here. Again, this was not really brought up in any way, shape, or form. Definitely not in any detail as it relates to the news. And I can understand why, because if you just see a hot CPI number and you're a news CEO, we'll just run that blip for the whole week and you'll probably make some money,
Yeah,
right?
just scare the hell out of the people and they'll pay attention to you.
That's pretty
It's
much
just
it. I don't.
Chicken Little, you know?
I'm not giving the audience or if this is your first time listening to this program, if you've just been an American citizen for any period of time, you would understand that this is just the way things roll from the media outlet. And again, they're for profit. Go make your profits, but just also understand that there's a reason why they're running with those headlines the way that they do. Now, CPI is not the only inflation measure, of course. There are other measures of inflation as well. January PPI, which is the wholesale index, so we just talked about headline CPI. Let's talk about the wholesale prices. So that also came in a little hot, came in at 0.28% month over month. But we believe that this points to a tame January PCE, which is the Fed's favorite measure of inflation, which we'll talk about here in just a second. Um, but I did want to give investors a little bit of good news. First of all, the market's positive year to date. Coming into today, the markets were up about 4.5%. Again, there's a little bit of volatility going on here today. So we'll see how things shake out. For our clients, we're up about 6.5% year to date. So again, this historical view that we look at the market through is providing an edge. Again, I said that the PPI came in hot. Not too concerned about that because we do believe that the core PCE, which is going to be the Fed's favorite measure of inflation, we do believe that's going to continue to fall. A lot of that has to do with the shelter component that we just referenced a couple minutes ago. In addition to that, we are getting a lot of volatility. Now, there's this index, as I'm sure that this is one of your favorite financial indices to keep track of. It's called the AAII percent net bulls.
I
Did you catch
love the
that?
AAII percent net bulls. It is one of my favorites. You're right.
That's right. It's a well-known no, it's not a well-known. Actually, it is for those that are, do this thing that I do. Again, this is kinda touched on sometimes, in a news outlet, but it's just an index that kinda measures how many bullish investors versus bearish investors, right? And it actually stands for something. It's called the American Association of Individual Investors. It's a reliable signal of strong forward returns. So here's some historical context. I know for sure this was not talked about in the news at all. And the way that you would read this, by the way, is the AAII percent net bulls is just the percentage of bullish investors minus percentage of bearish investors, and you get a data point. So the bottom decile, from the history of this particular index, the bottom decile is 90 to 95%. Um, and that's where most investors are right now. If you look at the actual index, now we haven't seen anything like this since like 2008. Now, when people get this bearish, here's the historical data point that I'm trying to bring to everybody's attention. The 6 month forward return on average has been 7.9% with a win ratio of 78% of the time. The 12-month forward return on average, when people get this bearish based on history, 12-month forward return, 17.7% average with a win ratio of 84%. Now, these are very strong forward returns and well above the 75-year rolling average, with the market producing about an 8% 12-month return over the last 75 years, again, on average. So these are way outpacing, historical average. And on top of that, Um, we also finished the month of January positive. This is something we talked about in a prior podcast. So when as January goes, so goes the rest of the year. In general, 89% of the time for the whole year, when January is positive, the market will be positive. So that's great. On top of this news I just gave you, and when January is positive and the market's positive for the year, the S&P tends to average right at about 18%. So all this is lining up very, very nicely. I know there's a lot of headline news, most of it being very political, whether it's wars that are trying to be ended or what have you. There's some actual fantastic historical news for the individual investor, and you're just not freaking hearing it unless you are part of this program here. And I know for sure, as asking this question, none of this has been discussed on the news. I mean, we've sent it to our clients. This is part of the reason why we want to communicate with them every single week, is because I know that they're watching the news. And if they're busy with fun stuff in, retirement years, they're traveling around and doing all kinds of fun things, or they're working still, I know that they're getting these news alerts on their phone in some way, shape, or form. I know that it's being talked about amongst themselves in their households, their friends, or their family members, coworkers at work. I know all this stuff, the headline stuff is being discussed. And you can see how that would build upon itself. If everybody around the water cooler at work, as an example, is talking about how freaking terrible, the stock market is and super volatile and this and that. Well, if you actually look at, the market under the hood from this lens of history, I'm having a very difficult time getting as bearish as a lot of people want to get, specifically based on the data set that we just talked about here. So there is a lot to get excited about this year, even though you might look at the news on any one given day and feel like, damn, this might be a real, tough year for stocks. And you're seeing some companies actually take it on the chin right now. For example, Palantir. This is an AI play in the defense industry. This has been a darling of Wall Street, better than a 50% return year to date. We're not even done with Q1. The great news is Shepherd Wealth Management's been a holder of this stock, and we've benefited greatly. Our clients are loving it. Unfortunately, though, there was a headline news yesterday, right around close to market close. Defense Secretary Pete Hegseth coming out and saying, "Hey, we're going to do a big cut of the defense budget of X amount of dollars over the course of the next 5 years." I don't have an issue with that. They failed all their audits for the last 7 years, so change is probably a good thing in some way, shape, or form. I root for them anyway, as part of being able to do what they think is in the best interest of the American people. However, that news really wasn't news. I mean, there's a whole department that was created to cut spending, waste, fraud, abuse, et cetera, et cetera. And everybody probably has their own opinions on that. I'm not giving mine today. I'm just simply saying the market reaction to that headline was just wild. Palantir was down 12% yesterday alone. And before we started to today's podcast, last I saw it was down another 10, 11% here today in today's trading session. We'll see how it finishes. Investors have been buying a lot of the dip. But again, this is a company that destroyed their earnings in January. Stock was up 25% or better post earnings announcement in, instantly. And now you're seeing a major sell off with one headline about cutting some spending. Now, the interesting thing about this this specific situation is, and again, this isn't talked about in the news at all. Why would it be? All you have to do is say, "Oh, Palantir is down 12%," and then you see a follow through here again today. Our view on Palantir is they have a unique software approach that will enable the company to gain more of the budget because they're using artificial intelligence through defense, the military. So if you're going to reduce spending, well, things that get more efficient, that's exactly what AI is, by the way. I don't think anybody would debate that. Um, but you're getting the knee jerk reaction because of the headline. Now, Walmart, as an example, had really good earnings, but they gave a not so great forecast. And this is kind of typical. You would see a company that maybe has really good earnings, good sales, good growth year over year, month over or quarter over quarter, year over year. Walmart had all of that going on. But they did say that they thought that their sales might slow a little bit, kind of going forward. The stock's down about 6% as we're talking here. So that's kind of typical. Does it deserve a 6% sell off post that announcement? I don't know. We'll see how things shake out here the next day. But that's more of a natural reaction, right? When you're watching corporate earnings, you could have, headline numbers be awesome, but if the CEO, CFO is like, yeah, we're kind of seeing sales maybe slow down a little bit, you would see a little sell off like this. I wouldn't, think too much of it. But when you have a company that just demolishes earnings like Palantir did in January, then their January announcement from Q4 earnings, stock explodes. And a lot of that had to do with not just their earnings beat, but they said, hey, we're going to increase our guidance, meaning that we're going to sell a lot more of our product here than we originally thought coming into 2025. So boom, stock goes the opposite direction, pops up 25 plus percent, up 50 plus percent year to date. And then you get that news yesterday, 12% sell off. You're still seeing that happen here today. This is why, if you look at the market on just a 1 day basis, tick by tick throughout the day, it's a live autopsy of human emotion. That's all it is. The market's made up of a bunch of human beings, and they see a lot of the headline news. They sell first and ask questions later, right? I'm looking at this as a buying opportunity, quite frankly. But we'll let some of this volatility shake itself out just a little bit because next week on Wednesday, right after the market closes, we'll be celebrating with clients and looking very much forward to that. But Wednesday of next week after the close, we get a very, very important earnings announcement from none other than NVIDIA, which is the largest chip maker on the planet. For those that haven't heard about it, I know our clients have because they've enjoyed the uh, skyrocket type of growth that this company's been able to achieve over the last couple years.
Oh my god,
And
astronomical. I mean,
yeah, I mean, it's just awesome.
yeah, it is
Um,
impressive to watch, I mean, it's crazy.
Jensen Huang, their CEO, has already come out and said that deep seek thing, that was actually a deep fake, in my opinion. Not going to hurt, their sales, their trajectory of growth in any way, shape, or form. Matter of fact, I keep want to call it deep fake. DeepSeek actually used I don't know how many NVIDIA chips to create what they created, and it certainly cost more than $6 million. Everybody's kind of debunked all that. Headline risk, by the way, that was one of those headline risks that caused companies like Palantir and NVIDIA and others to have a major sell off, and they got it all back in a very short period of time. I expect the same thing to happen here with a company like Peloton,
Yeah,
or
that
not
whole thing was
Peloton,
like a little
Palantir.
mini Theranos. Remember that? It was like a little micro compressed version of the Theranos, like
Yeah.
pop off, you know?
Yeah, I mean, it's just wild. So Palantir is what I meant to say. I said Peloton. I'm thinking about my workout coming up here.
Nice.
Um, which, by the way, that's another interesting stock story there. Since we're talking about market being like a live autopsy of human emotion, go check that chart out. Right as COVID happened, you're talking about $150 stock that today is worth about $9, right? So when Warren Buffett talks about a moat of safety for a company, what he means by that is Apple as an example. They make hardware and software, phones, earbuds, all the things that Apple makes. They sell things through their app stores, et cetera, et cetera. They have a wide moat, meaning that if you were going to take on Apple, if you're like, I'm going to go into business and I'm going to make smartphones and software and all the same things that Apple, you're going to compete directly with Apple. Well, you can do that just like you could try to compete with Coca-Cola, but not only are you going to need a ton of time, money, and resources, human being resources, to pull off something like a direct, true competitor of an Apple, let's say, you're going to have a hard time with that, right? You're going to have to make a better product. You're going to have a better value proposition. You're going to have a better everything. And that's going to be extremely difficult for you to do across all those segments of that business. But Peloton, they just make exercise equipment. There's a lot of people that make exercise equipment that could throw a TV on it, to stream YouTube while you're working out or whatever, right? They had a moment where they did have an advantage. They had a product that was home equipment that was better than probably most other products out there at that moment in time. You couldn't go anywhere, couldn't go to a gym. Again, very little supply of bikes, whole bunch of demand, stock goes up. Once everybody is in the gym equipment business is like, hey, I want some of that. You can see where the share price goes. They don't have a mode of safety for their business. Anybody could really directly compete with that product, where it would be very difficult to compete with an Apple, as an example. So I hope that makes sense. Let's see what else we got here for the viewers today. As that was the majority of everything. So I'm looking at again January core PCE coming in at 0.28 month over month, and January core CPI 0.45. We actually expect that PCE is going to tell a much more muted inflation story, but we'll see how that shakes out here in the coming weeks. Next week, though, as I mentioned, huge week from an earnings standpoint, and looking forward to that. The next Fed meeting is going to be March 19th, so we have a lot of time here before we get to another Fed meeting. Now, as I mentioned, earnings season's awesome. Earnings per share growth is accelerating. You're seeing expansion in manufacturing. What that means is the ISM manufacturing index that move above 50 for the first time in nearly 3 years. That's expansion territory that usually follows through with a really strong S&P for the full calendar year. There's a whole bunch of reasons to be bullish. I just gave you the contrarian view. There's a lot of retail investors and investors in general that are just straight up bearish. And we see those types of historically odd bearish investor numbers, meaning that everybody's kind of moving to one side of the boat, if you will. Everybody's agreeing that this sucks. Well, that's usually where we want to be greedy when others are fearful, is what Warren Buffett would say. And I want to be fearful when others are greedy. I just gave you guys all the historical reasons as to why you would want to take a contrarian view when this many investors want to be bearish. And on top of that, we also have the history of positive January in our favor. Again, I know half of my clients are Democrat, half of them are Republican. I'm not hired to give a political opinion. I'm hired to make money for my customers or to protect their gain. The best thing that any investor can do in this kind of environment is to understand how other human beings have behaved. And if you understand how other human beings have behaved and you can marry that with the fundamental uh, economic data that we have and the historical data that you can lay on top of that, you will have full control over your personal emotions. You can remove all that noise from the equation and take advantage of everybody else's crazy. This is exactly what we're here to do for our customers. This is what has made us successful, is being able to understand what's going on, marry all the fundamental and macroeconomic news with history and data, and make decisions based on that, as opposed to, well, my gut says this, or I feel like this may happen. Uh, you can try that. It definitely has not worked out too well for hedge funds. Matter of fact, hedge funds on average over the last 3 years have significantly underperformed the S&P 500, all in the name of, well, the stock market's overvalued. PE ratios above its 100-year historical average. Well, if that's you, unfortunately, in the name of PE ratios, that's cost you a lot of money. Your opportunity cost was very high. If you were just assuming that there was going to have to be this major meltdown of the stock market before you could participate in it, because the PE ratio of the S&P 500 is way above its historical average. That's a bunch of BS, and certainly not a way to go about making long-term success happen for yourself, or for hedge funds that are managing this for other people and charging more than twice what we charge here, just to underperform Vanguard. By the way, that sucks when you say it like that. I mean, you could have bought freaking VOO, which costs you nothing, and you'd done better than a flipping hedge fund. Maybe that'll be a topic of conversation for client celebration, as we got a lot to ponder there. But that's it. That's everything I got to cover here today. I really did enjoy giving this message to our viewers. Please like, share, subscribe to our channel. And we like to do this about every 2 weeks. So we'll catch you guys in early March. It'll be time to break out some brackets and get to work on all of that. So looking forward to it. Please leave your comments right below on the YouTube channel. And if there's anything that you have on top of your mind that you want to ask, please do so. Be happy to address it in our next podcast. Until then, wish you all a happy Thursday, and God bless. Take care.